When you step into the market, you don't bring just your strategy, your charts, or your indicators. You bring your entire psychological makeup. Every belief you formed about risk, reward, loss, fairness, and uncertainty sits right behind you, waiting to influence your decisions the moment money is on the line. And that is where the emotional traps begin. They are subtle at first, almost invisible, because they don't present themselves as psychological failures. They disguise themselves as logic, as conviction, as intuition, even as discipline. But deep underneath, they are emotional impulses trying to protect you from the discomfort of uncertainty, or from the pain of loss, or from the fear of missing out on opportunity. And the trader who doesn't recognize these traps early on ends up in the same cycle that destroys most market participants, long before they ever understand what went wrong. One of the most dangerous traps is the illusion of control. The market gives you just enough moments where your predictions line up perfectly with price movement, tempting you into believing you can forecast what comes next simply because the last trade went your way. That illusion becomes a psychological high, something your mind starts chasing without realizing it. You begin to confuse random outcomes with personal skill, and every trade becomes a test of your ego rather than an execution of your plan. The moment the market behaves unexpectedly, it's not just a losing trade, it becomes a personal contradiction, something your emotions feel compelled to fight rather than accept. Then there is the trap of needing to be right. This one is woven deep into human nature. From childhood, society trains us to seek correctness, validation, accuracy. But in trading, the need to be right is the fastest path to destructive behavior. It pushes you to hold losers, to add to losing positions, to justify irrational decisions simply because accepting you were wrong feels more painful than taking the actual loss. The market doesn't punish you for being wrong. It punishes you for refusing to accept it quickly. Another trap emerges when traders attach emotional meaning to single outcomes. One win makes you feel invincible. One loss makes you question everything. This emotional volatility becomes more damaging than price volatility itself. It blinds you to the fact that trading is nothing more than a series of probabilities playing out over time. Yet the mind clings to outcome-based identity, tying self-worth to every tick of the chart, creating a roller coaster that destroys objectivity piece by piece. And hovering behind all of these is the most silent trap of all, the fear of uncertainty. The market is a place where anything can happen, where no outcome is guaranteed, and where even the best setups sometimes fail for reasons you'll never understand. The human mind wasn't built to thrive under that kind of ambiguity. It seeks patterns, predictability, emotional comfort. But the market offers none of that. And so the trader who hasn't trained their mind to coexist with uncertainty becomes reactive, impulsive, defensive, and eventually overwhelmed. These traps don't destroy traders because they are powerful. They destroy traders because most never learn to recognize them before they take control. The illusion of control is one of the most pervasive psychological traps that a trader can fall into. And it is one that is so subtle that even the most experienced participants in the market often fail to recognize it until it has already influenced countless decisions. It begins with small successes, the moments when a trade you take aligns perfectly with your prediction, when a chart pattern you studied seems to confirm your intuition, when the market moves exactly as you expected. These moments feel like proof that your analysis is accurate, proof that your judgment is reliable, proof that you can somehow shape the market to your will. But these are illusions. They are fleeting coincidences that give the mind a sense of mastery over something that, in reality, cannot be controlled. The danger is that every correct prediction, every successful trade reinforces a belief that grows stronger over time, the belief that you can reliably control outcomes in an environment that is inherently uncertain and probabilistic. When a trader experiences this illusion of control, their decisions start to shift from disciplined, methodical analysis to emotionally charged behavior that is driven by confidence born out of randomness. You begin to interpret patterns as personal signals, as though the market is communicating directly with you. You might notice that certain setups you recognize repeatedly yield results, and you take this as confirmation that your ability to read the market is superior. This confidence becomes seductive because it feels like mastery, but it is a mastery built on perception rather than reality. The trader who falls into this trap begins to treat every trade as a test of personal skill, rather than an execution of a well-defined plan. And the distinction is crucial because the former invites risk-taking that is not justified by probability, while the latter keeps the mind grounded in disciplined action. The illusion of control also interacts with other emotional tendencies to amplify its effect. For example, when a trader believes they are in control, they are less likely to follow strict risk management rules. The idea of a stop loss, a predefined exit, or a limit on exposure may feel unnecessary because the trader believes they can sense when a trade is going against them and can exit before the market causes damage. This overconfidence often leads to taking larger positions, holding trades too long, or adding to positions in the belief that skill can overcome randomness. Yet the market does not bend to anyone's will. A single unexpected move can wipe out the gains accrued over months of trades, and the trader who was operating under the illusion of control is suddenly confronted with losses that feel inexplicable, shocking, and deeply personal. Another aspect of this illusion is how it affects the way a trader interprets losses. When a loss occurs, it is easy to dismiss it as a fluke or an anomaly because the mind has been trained to see itself as competent. The narrative becomes one of exception rather than rule. The trader may think, I just need to adjust my timing, or I misread the setup slightly, I still have the ability to predict correctly. Each loss is rationalized as a temporary deviation from an otherwise accurate judgment, and this rationalization reinforces the belief in personal control. It prevents the development of humility, which is one of the most critical qualities for consistent trading. Humility allows a trader to accept that no amount of skill can guarantee a specific outcome in a probabilistic environment, and that adherence to strategy, discipline, and risk management is more important than the ego-driven need to feel in control. The illusion of control also influences behavior outside of individual trades and seeps into broader market interactions. Traders may begin to believe that they can anticipate the collective behavior of the market, predict major moves before they happen, or outthink other participants. This can lead to overtrading, excessive confidence in forecasts, and taking positions that are not supported by probability or strategy. Every decision becomes imbued with the sense that personal insight or intuition has the power to bend the market, which is never true. The market operates independently of belief, and outcomes are determined by countless participants, random events, and the convergence of probabilities that no single individual can reliably influence. Psychologically, the illusion of control is reinforced by the brain's natural tendencies. Humans are wired to detect patterns and assign causality even when none exists. When a trader experiences a series of wins, the brain constructs a narrative of skill and mastery to explain these outcomes. This narrative feels real because it aligns with the brain's desire for predictability and control. Cognitive biases such as confirmation bias, overconfidence, and selective memory further strengthen the belief in personal control. Wins are remembered vividly, internalized as proof of ability, while losses are minimized, rationalized, or attributed to external factors rather than personal error. This creates a feedback loop in which the trader's confidence grows, while the ability to objectively assess risk diminishes. Traders who are aware of this trap recognize that no matter how many successful trades they have, the market remains unpredictable. They understand that their role is not to control outcomes, but to manage risk, to follow a plan, and to execute decisions with discipline. Awareness is the first step toward breaking free from the illusion of control. By examining each trade dispassionately, focusing on probability rather than certainty, and acknowledging the limits of personal influence, a trader can prevent confidence from becoming hubris. Awareness also helps to recognize the emotional cues that signal when the mind is slipping into the trap, such as feelings of invincibility, impatience, or the compulsion to act impulsively based on perceived insight. The illusion of control is not eliminated by knowledge alone. Experience is necessary, but it must be coupled with self-reflection and emotional discipline. Traders must confront the uncomfortable reality that losing trades are inevitable, that outcomes cannot be dictated by belief, and that risk is an inherent part of participation. They must cultivate the ability to detach self-worth from individual results and to see trading as a probabilistic game where consistency arises not from perfect prediction but from adherence to process. Over time, disciplined traders learn to accept the limits of their influence, respect the power of uncertainty, and develop strategies that are resilient against the psychological seduction of control. Recognizing this trap also involves studying one's behavior over time. Patterns emerge not just in the market, but in how a trader reacts to wins, losses, streaks, and unexpected events. The trader who believes in control will often escalate positions after a series of wins, ignore risk limits, and rationalize losses as anomalies. By identifying these tendencies, traders can implement checks and balances such as predefined trade plans, strict risk management, journaling, and regular review of emotional responses. The goal is not to eliminate confidence. Confidence is necessary, but to ensure that it is grounded in process rather than fantasy. The illusion of control is a constant presence because it appeals to the deepest desires of the human psyche, the desire for certainty, mastery, and predictability. It thrives in an environment like the market, where success feels tangible, where wins can appear as validation, and where the stakes create intense emotional responses. The traders who succumb to this trap do so gradually, often over years, and the consequences accumulate silently until they manifest in dramatic losses. Understanding this dynamic, internalizing its implications, and structuring behavior around the reality of probability rather than perception of control is what separates traders who survive and thrive from those who are ultimately destroyed. The need to be right is one of the most destructive emotional traps a trader can encounter, and it is deeply rooted in human nature. From early childhood, we are conditioned to seek correctness, validation, and approval. We learn to value being right because society praises it, rewards it, and constructs a sense of self-worth around it. In trading, however, this innate need becomes a liability rather than an asset. The market does not care about our desire to be right, and it does not conform to personal beliefs or expectations. Every trade is a probabilistic event, not a moral or personal judgment, and the moment a trader allows the need to be right to dictate decisions, objectivity is lost. This emotional drive transforms simple decision-making into a high-stakes psychological struggle, one where the ego becomes the opponent, and the market exploits every vulnerability. When a trader is driven by the need to be right, the first impact is on position management. Losing trades are no longer accepted as part of the process. They are viewed as failures, personal affronts, or threats to self-esteem. Instead of exiting a trade when it goes against the predefined plan, the trader holds on, hoping that the market will reverse in order to justify their initial judgment. The longer the position is held, the larger the potential loss becomes, and the more emotional commitment builds. Every tick against the trade feels like proof of incompetence, creating anxiety, frustration, and tension. These emotions cloud judgment, reducing the ability to assess the situation rationally, and often lead to impulsive decisions that compound losses rather than mitigate them. Another manifestation of the need to be right is the tendency to add to losing positions. A trader may rationalize that increasing exposure will turn the trade into a winner, as though the act of adding more capital will somehow force the market to conform to their original analysis. This is a classic example of ego-driven decision-making, where the focus is on proving correctness rather than following probability-based strategy. The irony is that adding to a losing position rarely resolves the underlying problem, it simply magnifies risk. Traders who fall into this pattern often fail to recognize the cumulative effect of repeated small rationalizations, which over time lead to catastrophic outcomes that could have been avoided with discipline and detachment from the need to be right. The need to be right also distorts the evaluation of trades after they are closed. Wins are celebrated as proof of skill, while losses are rationalized as mistakes, anomalies, or bad luck. This biased perception reinforces the emotional attachment to being correct. The mind begins to construct a narrative in which success is always deserved and failure is always avoidable. The danger of this narrative is that it prevents learning. Traders who cannot objectively analyze losses miss the opportunity to understand their own behavior, identify flaws in their strategy, and refine their approach. Instead, they focus on protecting ego and reputation, often repeating the same mistakes over and over, convinced that the next time they will be proven right. Confirmation bias plays a major role in reinforcing the need to be right. Traders naturally seek information that supports their existing beliefs and ignore evidence that contradicts them. When a trade is entered, every piece of news, chart movement, or commentary is filtered through the lens of validation. The trader interprets favorable signals as justification and dismisses unfavorable ones as irrelevant or misleading. This selective perception strengthens confidence, even in the face of mounting evidence that the position is failing. It is a dangerous feedback loop in which the desire to be right overrides reality, leading to poor decision-making and increasing exposure to risk. The psychological impact of this need is not limited to individual trades. It also affects overall market behavior and the development of trading habits. Traders who are overly concerned with being right tend to overtrade, chasing setups that confirm their biases, or attempting to reverse perceived mistakes immediately. They may avoid stopping out of trades because doing so feels like an admission of error, and they may place excessive focus on predicting short-term market movements rather than following a disciplined, rules-based approach. The accumulation of these behaviors reduces consistency, increases emotional volatility, and ultimately undermines long-term performance. In addition, the need to be right amplifies the emotional weight of losses. Because the mind equates being wrong with personal failure, each losing trade carries a disproportionate psychological burden. Anxiety rises, confidence erodes, and the ability to act objectively diminishes. In this state, even minor market fluctuations can trigger overreaction, leading to impulsive decisions such as abandoning strategy, entering trades without preparation, or overcompensating with larger positions. Traders become reactive rather than proactive, responding emotionally rather than executing a well-defined plan. The result is a cycle of frustration, risk-taking, and self-reinforcing mistakes that can escalate until a single event triggers a major drawdown. The need to be right also interferes with adaptability. Markets are dynamic and conditions change constantly. Strategies that work in one environment may fail in another, yet a trader attached to being right may resist adjusting tactics because doing so feels like admitting past mistakes. Flexibility is sacrificed in favor of ego preservation, which diminishes the ability to navigate evolving market conditions successfully. The most consistent and profitable traders recognize that accepting being wrong is not a weakness, but a prerequisite for adaptation. By letting go of the need to be right, they can focus on following probabilities, adjusting strategies, and managing risk effectively. Self-awareness is critical in overcoming this trap. Traders must learn to separate personal identity from market outcomes. Confidence in strategy should be grounded in process, not in the pursuit of personal validation. Every trade should be evaluated in terms of adherence to rules, risk management, and probability, rather than whether it confirms the trader's sense of correctness. Journaling trades, reviewing decisions objectively, and cultivating emotional detachment are all methods to reduce the influence of the need to be right. By systematically analyzing behavior, traders can identify moments when ego-driven impulses are dictating action and implement interventions that reinforce discipline and rational decision-making. Education alone does not resolve the need to be right. Experience and reflection are necessary. Traders must encounter losses and recognize that being wrong is not a catastrophe, but an inevitable aspect of probabilistic environments. They must understand that the market does not reward ego, that emotional attachment to correctness increases vulnerability, and that success depends on adherence to process rather than outcome. Over time, the disciplined trader learns to embrace the reality that being wrong is not only acceptable, but essential for learning, adaptation, and growth. The need to be right is amplified by cognitive biases that distort perception and reinforce ego-driven decision-making. Overconfidence bias makes wins feel like proof of mastery. Anchoring bias causes traders to cling to initial judgments even as new information emerges. And selective memory ensures that victories are remembered more vividly than losses. These biases combine to strengthen the psychological grip of the need to be right, making it increasingly difficult to act rationally in the face of uncertainty. Risk management becomes secondary to ego when this need dominates behavior. Traders take larger positions than planned, hold losing trades too long, and enter new positions prematurely to offset prior errors. The compulsion to prove correctness overrides logic, probability, and strategic discipline. In this state, even the best tools, analysis, and preparation are rendered ineffective because decisions are driven by emotion rather than process. Breaking free from this trap requires conscious effort and emotional training. Traders must accept that being wrong is a natural and inevitable part of the market. They must focus on consistency, adherence to strategy, and disciplined execution rather than on proving personal correctness. Developing emotional resilience, cultivating self-awareness, and implementing systematic checks on behavior are essential to reducing the influence of the need to be right. Over time, disciplined traders learn to embrace mistakes as opportunities to learn, recognize the limits of personal influence, and detach ego from outcomes. By doing so, they transform the need to be right from a destructive force into a neutral factor, allowing rational decision-making, consistent risk management, and adherence to probability to guide their actions. This awareness fosters adaptability, reduces emotional volatility, and lays the foundation for long-term success. Emotional attachment to single outcomes is a subtle yet highly destructive trap that affects traders at every level of experience. It occurs when a trader links personal identity, self-worth, or emotional satisfaction to the result of an individual trade rather than focusing on the process, probability, and overall strategy. Trading is inherently probabilistic, meaning that no single trade guarantees success, regardless of preparation, analysis, or skill. Yet the human mind struggles to separate the outcome of a single event from a sense of competence or failure. A winning trade can create a temporary feeling of invincibility, while a losing trade can trigger frustration, self-doubt, and a sense of personal inadequacy. The danger of this emotional attachment is that it clouds judgment, encourages reactive decision-making, and undermines consistency, which is the foundation of successful trading over time. When a trader becomes emotionally attached to a single outcome, every decision starts to carry disproportionate weight. For example, a trader may enter a position with a well-defined plan and risk management, only to find that a small fluctuation in price triggers intense emotional reactions. A slight adverse movement may cause anxiety, fear, or even panic, leading to premature exits, impulsive adjustments, or attempts to correct what is perceived as a mistake. Conversely, a favorable move can create overconfidence, prompting the trader to increase position size, take unnecessary risks, or deviate from their plan in the belief that their skill guarantees continued success. In both cases, the attachment to a single outcome distorts perception and erodes the objectivity required for consistent trading. This attachment also amplifies the psychological impact of wins and losses. One profitable trade may feel like proof of mastery, leading to a false sense of competence that is not supported by statistical probability. The trader begins to overvalue the result of that single trade, interpreting it as evidence that their decisions are superior or that the market is yielding to their insight. On the other hand, a single loss can feel catastrophic, disproportionately affecting confidence, inducing self-doubt, and triggering fear of future trades. Emotional attachment to outcomes makes it difficult to view trades as individual components of a broader probabilistic framework, and instead each trade becomes a judgment on personal ability, intelligence, or worth. This attachment is reinforced by cognitive biases and natural human tendencies. Outcome bias, for instance, causes traders to evaluate decisions based on the result rather than the quality of the decision-making process. If a trade turns out well, it is seen as confirmation of skill. If it turns out poorly, it is perceived as failure, even if the decision-making process was sound. Confirmation bias further strengthens emotional attachment by causing traders to selectively interpret market information to validate their expectations, ignoring contradictory signals that could inform rational adjustments. Over time, these biases create a feedback loop in which traders increasingly define success or failure in terms of individual outcomes rather than adherence to process and probability. Emotional attachment also undermines risk management, which is a critical component of trading discipline. When a trader becomes fixated on a single outcome, they are more likely to violate predefined risk limits in an attempt to secure a favorable result or recover from an adverse one. This may include holding losing positions beyond acceptable thresholds, adding to positions impulsively, or over-leveraging in pursuit of a winning trade. The moment emotional attachment dictates action, rational evaluation of risk is sidelined and the trader exposes themselves to losses that are inconsistent with long-term probability-based strategy. This attachment further impacts the trader's ability to remain consistent across multiple trades. Trading is not about predicting the outcome of a single event. It is about executing a plan with discipline, managing risk effectively, and letting the probabilistic nature of the market work over time. When a trader focuses on individual results, they start to make decisions based on emotion, fear, or hope rather than analysis and process. This leads to erratic behavior, impulsive reactions, and a gradual erosion of the systematic approach required for sustained success. Consistency is replaced with volatility, not in the market, but in the trader's mind, decision-making and execution. Overconfidence following a winning trade is one of the most common consequences of attachment to outcomes. A single win can create a temporary feeling of invulnerability, leading traders to increase position sizes, reduce caution, or deviate from established rules. They may perceive skill where there was luck, and this misperception fuels the desire to repeat favorable outcomes. The problem is that markets are unpredictable, and past success does not guarantee future results. Overconfidence drives risk exposure beyond what is justified by probability and planning, making the trader vulnerable to sharp reversals and losses that could have been avoided with disciplined adherence to process. Conversely, the negative side of attachment emerges after losses. Traders may become defensive, fearful, or hesitant to take new positions. They may overanalyze or second-guess their strategy, allowing doubt to influence decision-making. Emotional attachment to losses can lead to revenge trading, where the trader attempts to recoup losses quickly, often taking high-risk positions without proper analysis. This behavior is rarely productive. Instead, it escalates losses, reinforces stress, and traps the trader in a cycle of emotional reaction rather than strategic execution. Breaking the cycle of emotional attachment requires awareness and deliberate practice. Traders must learn to separate personal identity from the outcome of any single trade and instead focus on the quality of their decisions and adherence to risk management. Developing a mindset that views each trade as a data point within a broader statistical framework helps reduce the emotional intensity associated with wins and losses. Journaling trades, reviewing performance systematically, and reflecting on the decision-making process rather than the result are key strategies to mitigate the influence of attachment to outcomes. Traders also need to cultivate emotional discipline to handle the natural fluctuations of the market without overreacting to single events. This includes recognizing the emotional cues that indicate attachment, such as excitement, fear, or defensiveness, and implementing predetermined strategies to maintain objectivity. By accepting that losses are inevitable and wins are probabilistic, traders can reduce the psychological pressure of each trade and make decisions aligned with long-term strategy rather than short-term emotion. Attachment to outcomes is particularly dangerous because it interferes with the learning process. Traders who equate success with being right are less likely to objectively analyze mistakes and adjust their approach. They focus on defending ego rather than improving strategy, which stunts growth and increases vulnerability to repeated errors. By shifting focus from results to process, traders can evaluate decisions rationally, learn from mistakes without emotional interference, and develop resilience that supports consistent performance over time. Ultimately, emotional attachment to single outcomes creates a psychological environment where every trade feels disproportionately important, where judgment is clouded by hope, fear, or overconfidence, and where consistent execution is compromised. It leads to violations of risk management, reactive decision-making, and a distorted perception of skill and probability. Traders who recognize this trap and consciously detach their self-worth from individual results develop the discipline, objectivity, and emotional resilience necessary to navigate the inherent uncertainty of the market successfully. Uncertainty is the central reality of the market, and yet it is the single factor that triggers the most destructive emotional responses in traders. The fear of uncertainty is a deeply ingrained psychological response, rooted in the human need for predictability, safety, and control. When a trader confronts the fact that the market is inherently unpredictable, that no strategy guarantees success, and that outcomes are probabilistic rather than certain, it creates tension between rational understanding and emotional reaction. This tension is where impulsive, reactive decisions emerge. The trader who has not trained the mind to coexist with uncertainty becomes vulnerable to fear, overreaction, and loss of discipline. Every trade becomes a test not just of skill but of emotional resilience, and the inability to tolerate uncertainty is a primary reason why so many traders fail. Fear of uncertainty manifests in several ways, starting with hesitation and indecision. Traders may recognize a trade setup that aligns perfectly with their strategy, but doubt creeps in because the market could move against them unpredictably. This hesitation often results in missed opportunities, premature exits, or partial entries that undermine potential profits. The trader's focus shifts from executing a well-defined plan to trying to anticipate every possible market scenario. Ironically, the more a trader tries to control uncertainty, the more reactive and inconsistent their behavior becomes. leading to a self-fulfilling cycle of missed opportunities and heightened anxiety. Another manifestation of fear is overtrading, which paradoxically occurs when traders try to regain a sense of control over an uncertain environment. Feeling that they cannot predict the market, some traders act compulsively, taking multiple trades in rapid succession to feel involved, to counteract previous losses, or to confirm their judgment. Each impulsive trade is an attempt to assert control over randomness, but in doing so, the trader amplifies exposure to risk and reduces adherence to strategy. Overtrading is often accompanied by emotional volatility, where each tick of the market produces intense feelings of fear, excitement, or regret, further diminishing objectivity and rationality. The fear of uncertainty also drives the need for certainty, which can manifest as rigid adherence to patterns, over-reliance on indicators, or excessive analysis. Traders attempt to reduce ambiguity by seeking signals that promise predictable outcomes. Yet, no pattern, indicator, or setup can guarantee a specific result because the market is influenced by countless variables, many of which are beyond observation or control. The pursuit of certainty creates a false sense of security, and when trades inevitably deviate from expectation, the trader experiences heightened emotional stress. The struggle to maintain control in an uncontrollable environment leads to impulsive actions, abandonment of risk management rules, and erosion of discipline. Another consequence of fear-driven behavior is premature exits or chasing the market. When uncertainty triggers anxiety, a trader may close positions too early to avoid potential losses or enter trades impulsively in an attempt to recapture perceived missed opportunities. These behaviors are rooted not in strategy or probability, but in emotional reactions to the discomfort of uncertainty. They disrupt the consistent application of rules and interfere with the probabilistic approach that underpins long-term trading success. Each action taken to reduce fear paradoxically increases risk and diminishes performance. Cognitive biases further amplify the fear of uncertainty. Loss aversion, for instance, makes the pain of potential losses feel more intense than the pleasure of equivalent gains, creating an exaggerated response to adverse market movements. Overconfidence bias can create a temporary illusion of control, but when the market behaves unpredictably, it collapses, leaving the trader vulnerable to panic. Anchoring bias causes traders to fixate on initial price levels or predictions, interpreting deviations as threats to their judgment rather than natural probabilistic outcomes. These biases interact with emotional responses to uncertainty, producing behavior that is reactive, inconsistent, and counterproductive. The inability to tolerate uncertainty also affects position sizing and risk management. Traders who fear unpredictable outcomes may reduce position sizes excessively, attempting to minimize exposure, or conversely, they may overcompensate by taking positions that are too large in a bid to assert control. Both extremes undermine consistency as decisions are guided by emotion rather than probability. The trader's challenge is to find a balance, accepting that uncertainty is unavoidable while implementing a structured approach that mitigates risk and allows for disciplined execution. Fear of uncertainty impacts not just individual trades, but the trader's overall approach and mindset. It fosters a reactive mentality, where decisions are driven by immediate emotional responses rather than strategic planning. Traders may spend excessive time analyzing every potential scenario, second-guessing decisions, or trying to predict every market movement. This mental overload diminishes clarity, reduces the ability to act decisively when necessary, and erodes confidence in process-based strategies. Ironically, the trader's effort to manage uncertainty creates more volatility in behavior than the market itself. Emotional awareness is critical in overcoming this trap. Traders must recognize the physical and psychological cues that indicate anxiety or fear-driven reactions, such as restlessness, rapid heartbeat, or compulsive thinking about potential losses. Identifying these signals allows traders to pause, reflect, and return focus to process-oriented decision-making. Developing mental discipline through techniques such as journaling, visualization, or mindfulness strengthens the ability to tolerate uncertainty without reacting impulsively. Another strategy to mitigate the impact of uncertainty is the systematic implementation of risk management rules. By defining stop-loss levels, position sizes, and trade plans in advance, traders remove emotional decision-making from the immediate environment of the trade. Predefined rules act as a buffer against the natural tendency to overreact, allowing the mind to accept that outcomes are probabilistic and that losses are part of a structured approach rather than personal failure. Consistent adherence to these rules builds confidence in the process, which reduces the need to act impulsively in response to uncertainty. Traders must also cultivate a mindset that reframes uncertainty as a neutral or even positive factor. Rather than perceiving unpredictable outcomes as threats, they can view them as natural expressions of market dynamics. Each trade becomes an opportunity to execute a plan, gather information, and refine strategy independent of the result. This perspective diminishes the emotional weight of individual trades, reduces overreaction, and fosters resilience. The fear of uncertainty is further compounded by the natural human desire for predictability and control. The brain is wired to seek patterns, anticipate outcomes, and minimize risk. In the market, however, these instincts conflict with reality. The inability to reconcile the desire for certainty with the probabilistic nature of trading leads to emotional conflict. Traders who recognize this tension and develop strategies to manage it are able to maintain discipline, reduce emotional volatility, and make decisions grounded in analysis rather than fear. Education and experience are necessary, but insufficient without emotional training. Traders may understand conceptually that markets are uncertain and outcomes probabilistic, but the emotional impact of live trading can override intellectual understanding. Repeated exposure to market fluctuations, combined with disciplined execution and reflection, gradually builds tolerance to uncertainty. Over time, traders learn to accept that outcomes cannot be controlled, that losses are inevitable, and that adherence to process, rather than prediction, is the key to long-term success. The fear of uncertainty is amplified in environments of high volatility, unexpected news, or rapid market changes. These conditions test emotional resilience, magnify cognitive biases, and create pressure to act impulsively. Traders who have trained to accept uncertainty, maintain discipline, and follow risk management protocols are able to navigate these periods without compromising strategy. In contrast, those who react emotionally are prone to mistakes, overtrading, and unnecessary risk exposure. Uncertainty also interacts with other emotional traps, such as the need to be right or attachment to outcomes, to create compounded effects. A trader who fears unpredictable results may cling to being right, holding losing trades, or seeking validation from market movements. They may become emotionally attached to each outcome, experiencing heightened anxiety over individual trades rather than viewing them as part of a broader probabilistic framework. Recognizing these interactions is crucial for developing comprehensive emotional discipline and resilience. Developing tolerance to uncertainty requires conscious effort and structured practice. Traders must acknowledge the limits of control, accept the probabilistic nature of the market, and cultivate strategies that prioritize process over outcomes. Techniques such as journaling trades, reviewing emotional responses, and reflecting on decisions independent of results strengthen the ability to act rationally under pressure. Over time, repeated practice builds confidence in executing strategy despite uncertainty, reduces impulsive reactions, and fosters long-term consistency. The fear of uncertainty is a fundamental psychological challenge in trading because it touches on the core of human emotion, the need for control, predictability, and safety. Markets, by their nature, offer none of these guarantees, and the trader's success depends on the ability to navigate this reality with discipline, resilience, and emotional awareness. Recognizing fear, understanding its impact on behavior, and implementing strategies to manage its influence is essential for maintaining consistency, adhering to process, and executing trades rationally. Traders who learn to coexist with uncertainty gain a significant advantage as they can act decisively, maintain discipline, and focus on probability rather than outcome. They are less reactive, less impulsive, and more capable of executing plans systematically. By embracing uncertainty as an inherent aspect of trading and structuring behavior to accommodate it, traders reduce emotional volatility, improve decision-making, and create the conditions for sustained success. Ego-driven trading is one of the most insidious traps that can destroy a trader's performance because it operates silently beneath the surface, influencing decisions in subtle but profound ways. The ego is the part of the mind that seeks recognition, validation, and superiority. It thrives on being right, on winning, and on proving personal competence. In trading, ego manifests whenever a trader's decisions are influenced more by the desire to defend self-image than by rational analysis or adherence to process. While confidence and conviction are necessary traits for trading, when they are conflated with ego, they distort perception, compromise discipline, and create behavior patterns that are ultimately destructive. One of the primary ways ego interferes with trading is through the compulsion to be right. A trader driven by ego cannot easily accept that a position may be wrong or that a strategy may fail. Losses become personal affronts rather than expected probabilistic outcomes, and the mind seeks to rationalize, justify, or reverse them at all costs. This need to protect self-image leads to holding losing trades for too long, adding to positions in a futile attempt to prove correctness, and rationalizing poor decisions with elaborate mental constructs. Each action driven by ego is intended to maintain a narrative of competence, but in reality, it increases exposure to risk and undermines objective decision-making. Ego-driven traders are also highly reactive to market feedback. Wins are celebrated not simply as the result of a disciplined process, but as validation of personal superiority. Each successful trade inflates self-importance, creating overconfidence and the illusion that the market is yielding to individual insight. This overconfidence often manifests as taking larger positions, overtrading, or ignoring risk management rules because the trader believes in the infallibility of their judgment. The market, however, operates independently of ego, and overconfidence built on personal validation rather than probability is one of the fastest paths to destructive losses. Conversely, ego amplifies the emotional impact of losses. The sting of being wrong is experienced not just as a financial setback, but as a challenge to identity and self-worth. The trader's mind interprets each loss as evidence of inadequacy, failure, or incompetence, triggering anxiety, frustration, and defensive behavior. This emotional turmoil leads to poor decision-making, exiting trades too early, chasing markets impulsively, or deviating from strategy to recover perceived losses. Ego converts ordinary trading outcomes into high-stakes psychological conflicts, where each decision is influenced by the fear of appearing wrong rather than the probability of success. Ego-driven behavior is also evident in the need to dominate or outsmart the market. Traders may develop a mindset in which every trade becomes a contest, a personal challenge to prove intelligence, skill, or superiority over other participants. This creates risk-seeking behavior, overanalysis, and obsession with proving personal insight. Rather than treating trading as a probabilistic system governed by process, the ego transforms it into a personal battlefield. Each unexpected move by the market is perceived as an attack, triggering defensive reactions that lead to impulsive and inconsistent actions. Another manifestation of ego in trading is selective perception and confirmation bias. Ego-driven traders focus on information that supports their beliefs and ignore evidence that contradicts their expectations. When a trade aligns with preconceived notions, it is interpreted as proof of skill. When it contradicts them, it is dismissed or rationalized. This distorted interpretation of information reinforces ego, strengthens overconfidence, and prevents objective assessment of trades. Traders become trapped in a feedback loop in which self-image dictates decision-making rather than rational analysis or adherence to strategy. Ego also undermines adaptability. Markets are dynamic, constantly changing, and influenced by innumerable factors. Traders who allow ego to dictate behavior resist adjusting strategies, refusing to accept that conditions have changed or that past assumptions may no longer hold. They may cling to losing positions, continue with failing strategies, or avoid experimenting with new approaches because doing so would require acknowledging imperfection. Flexibility, a critical component of successful trading, is compromised when ego dominates decision-making. The impact of ego is compounded by other emotional traps. When combined with the need to be right, attachment to outcomes, or fear of uncertainty, ego creates compounded risk. A trader may hold a losing position to protect self-image, become attached to a single outcome, and simultaneously fear that uncertainty will reveal incompetence. Each of these emotional triggers reinforces the others, producing behavior that is reactive, impulsive, and disconnected from probability-based strategy. Traders in this state are highly vulnerable to losses, not because the market is unpredictable, but because their own mind has become a primary source of instability. Ego-driven traders often ignore or resist risk management principles. Rules such as stop losses, position sizing, or trade limits are perceived as constraints that challenge self-perception or diminish the opportunity to assert dominance over the market. The ego convinces the trader that these structures are unnecessary because their judgment is sufficient. This behavior is dangerous because risk management exists precisely to mitigate the unpredictable nature of the market, and circumventing it for the sake of ego exposes the trader to losses that could have been avoided through disciplined execution. Developing self-awareness is critical to mitigating ego-driven trading. Traders must recognize the emotional cues that indicate ego is influencing behavior, such as defensiveness, rationalization, overconfidence, or obsession with proving skill. By acknowledging these tendencies, traders can pause, reflect, and return focus to probability, process, and adherence to strategy. Emotional awareness allows traders to separate personal identity from market outcomes, reducing the influence of ego on decision-making. Structured practices can also help manage ego. Journaling trades, reviewing decisions objectively, and reflecting on the decision-making process rather than outcomes reinforce the distinction between execution and result. Risk management protocols act as a safeguard, preventing impulsive actions driven by ego from overriding disciplined strategy. Over time, repeated reflection and structured analysis weaken the grip of ego, replacing reactionary behavior with rational, process-driven decision-making. Ego-driven behavior often manifests in the pursuit of validation from external sources such as peers, mentors, or social recognition. Traders may focus excessively on outperforming others, sharing results, or gaining approval, which shifts attention away from probability-based execution. This external validation reinforces ego, creating additional psychological pressure that interferes with objective analysis. Consistent trading success is rarely achieved through validation-seeking behavior, as it prioritizes perception over rational execution. Confidence must be distinguished from ego. Confidence arises from consistent adherence to process, understanding of risk, and experience with probabilistic outcomes. Ego, in contrast, is rooted in the desire to be perceived as competent, to win, and to assert dominance. Confidence supports rational decision-making and disciplined execution, whereas ego undermines objectivity and increases vulnerability to emotional reaction. Traders who understand this distinction are able to cultivate healthy confidence while keeping ego-driven impulses in check. Ego-driven trading also affects the interpretation of winning streaks. A series of successful trades can inflate ego, creating a false sense of invulnerability. The trader begins to believe that their judgment is flawless, that the market is predictable under their guidance, and that risk management is unnecessary. Each subsequent trade becomes an opportunity to assert superiority rather than a probabilistic decision to execute strategy. When the inevitable loss occurs, the emotional fallout is magnified, as it is perceived not just as a financial setback, but as a challenge to identity and self-worth. Conversely, ego amplifies the emotional impact of losing streaks. Traders may react with frustration, anger, or desperation, attempting to prove themselves through increasingly aggressive or impulsive behavior. This reaction is rarely productive and often accelerates losses, as decisions are driven by the need to restore self-image rather than adherence to process. The ego interprets losses as personal failure rather than probabilistic outcomes, creating a cycle of emotional reactivity that erodes discipline, judgment, and confidence. Overcoming ego-driven trading requires conscious effort, emotional discipline, and structured reflection. Traders must learn to detach self-worth from individual results, focus on probability rather than outcome, and evaluate decisions based on adherence to strategy rather than validation of skill. Journaling, reviewing trades objectively, and implementing strict risk management protocols are essential tools to reduce ego-driven behavior. Developing awareness of cognitive biases that reinforce ego, such as overconfidence, confirmation bias, or selective memory, is also critical for maintaining rational decision-making. Ego-driven trading undermines long-term consistency, emotional stability, and adherence to process. It transforms trading from a disciplined, probabilistic endeavor into a psychological battle in which the mind's need for validation dictates decisions. Traders who recognize the influence of ego, cultivate self-awareness, and implement structured strategies to mitigate its impact develop resilience, objectivity, and discipline, allowing rational decision-making to guide action rather than emotional impulses. By understanding the ways ego manifests, monitoring its influence, and focusing on process over perception, traders create conditions for consistent execution, risk management, and adaptation. This awareness transforms ego from a destructive force into a manageable factor, ensuring that decisions are guided by probability and strategy rather than identity, pride, or the desire for validation.